Hi everyone, Abdurrahman again is my name. You are welcome to today's lecture. Okay, the last lecture we said we are going to look at the cost of equity in detail. Now we know that ordinary share is given as equity. So what is the cost of equity? Now we are looking at it in detail today. KE, which is cost of equity, the formula for calculating cost of equity can either be DO lying on what? All over market value, which is MV market value. We know this now. Or DO into a bracket 1 plus G. This G is growth. G is growth. G is equal to growth. Why MV? We know what MV is before. MV is equal to market value. Okay? Or D1 all over MV plus G. So these are the various forms of calculating cost of equity. DO is what to dividend in year 0 or dividend now. DO is equal to dividend in year 0. Year 0. Why D1 is equal to dividend in year 1. Having said that, the question will tell you whether the dividend given to you is D0 or is D1. But in a case, how do you know what is the tone of the question for you to determine whether the dividend given to you is DO or D1? The question will specifically tells you, or the tone of the question will lead you to know whether it's DO by telling you that the dividend paid in year 0 or dividend paid is so. But if it is a case of what? D1, the question will let you know that dividend paid in year 1. If you hear what to year 1 or dividend paid in future is this. So in year 1 or dividend paid in future, it means what is D1. Now, another question is what? Now, how do you now come to the issue of what? Of growth. Looking at the past dividend paid by a company, we can tend to see whether there is growth in the dividend payment of that company or not. If the question gives you a list of what? A list of dividend paid for certain years back. Looking at looking at the dividend, you can tend to see whether there has been growth in that dividend or not. Or specifically, the examiner can tell you that the growth rate in dividend is so. When you are being given directly that the growth rate in dividend is so and so, fine, just take that rate into you. Use it here. It means the formula you are going to use is what? Is this formula. That is for you to include what? The growth rate in dividend. This deal is same as the dividend paid in year 0. Dividend paid in the last year, in year 0. Or dividend paid now. So is this deal? But they are not telling that there has been an element of growth into that dividend. So you are going to incorporate that element of growth here. So this market value is market value of the equity. The market value we are talking about here is market value of equity. Because here you are talking about company listed on the, is a public company listed on the stock exchange market. So for a company listed on the stock exchange market, it will definitely have what? Has what? A market value. So that is the market value we are making reference to here, as simple as that. So it is the market value that are going to do what? Pick. Calculate the dividend given to you in the question and all about what the market value given to you. As simple as that. Calculate it because you get a what? A cost of equity. In percentage term. So the same thing goes for this too. Mark you, look at this D1 they are talking about here. This is the dividend that is what that we paid in year 1. There has been element of growth in this D1. Simply put, D1 is equal to what? D0, open a bracket, 1 plus G. In simple financial mathematics, this one is representing what? To the element of what? Of this D1, D0. So just for this, your what? To 1 plus G as the rate, maybe 10%, that is 1.1 times this. You are going to get your D1. So D1 is what? So this is an extension of D1. But if you are given straight, you are given D1 straight away, you don't need to do what? To have this because it has been adjusted for already. That is the issue of what? Of D1. So your market value still remains the same. While your growth is what? Is the growth in that question given to you. Before we move further, before we start to calculate, this market value that you are talking about here must be what? To market value x diff. The market value must be what? Market value x diff. What does that market value x diff? Market value, must this market value must be what? To market value exclusive of dividend. So we short it to what? To market value. Short this to market value x diff. Market value. We call it what? X diff. Market value x diff. So what do you mean by market value x diff? Market value exclusive of dividend, excluding dividend. What do you mean by that? This market value, the market value I'm going to use here must be exclusive of dividend. That is, it must not include dividend. But the market value must not include what? Dividend. What are we saying here? How do we know whether market value is inclusive of dividend or exclusive of dividend? If market value is inclusive of dividend, you must do what? Adjust it. Remove what? Dividend from it in order to adjust it for what? For SDIF. In a nutshell, the market value you must use in your calculation must be market value x dividend. Now the question is, how do we now determine whether a market value is XDIF or is what? Is inclusive of dividend or exclusive of what? Of dividend. There are major things that I need to watch out for. There are major things in which you need to do what? To watch out for. Majorly 3. I need to watch out for you to determine whether the market value given to you in the question is inclusive of dividend or exclusive of dividend. The number one thing is what? The number one indicator is what? Where the examiner says what? The dividend is about to be paid. Watch out for this word, about to. In other words, dividend is about to be paid. To be paid. 2. Dividend is due for payment. Dividend is due for payment. 3. Dividend has been paid. Has been paid. Or number 4, okay, where the examiner is silent. Now, I can normally say it is no matter how difficult an answer a question is, no matter how lengthy a question is, the answer is in the question. It is the ability to decode the question that matters, not the question itself. If we can decode a particular question, the question is half solved. Now, looking at this now, I'm talking about the concept of market value. We said the market value for you to use must be what to market value XD. The market value XD, how do you now know whether the market value is inclusive? I said if market value is inclusive of dividend, you must remove the dividend from the market value before you use it to make it XD. Now, how do you now know whether this market value is inclusive of dividend or exclusive of dividend? Look at this. Dividend is about to be paid. In a question where they said the dividend is about to be paid, it means the dividend is due for payment but has not been paid. Just get it. It means the dividend is due for payment but it has not been paid. It's due. Dividend is about to be paid. That is, it is due already but has not been paid. Just like this. Dividend is due for payment but it's going to say the word is about to be paid. So it means the market value given to you in that question is what to market value inclusive of dividend. By that, therefore, you have to remove the element of dividend in that market value. That is why most of the time, if you look at the market value of shares at the end of the financial year, take, for example, December period. When you are entering the Ember period, September, October, November, December, what happened to the price of what? Of shares? The price of shares keeps what? Increasing. The price of what? Of shares keeps increasing. It means what? There are some elements of what? Of dividend in that market value. If you now go and look at it, the market value of that of such share in January, the following year, January, February, what happened to the market value of the share? It will drop. What happened to it? It is because they have paid out what? Dividend to ordinary shareholders. They have paid out dividend to what? Private shareholders. They have paid out what? Interest, everything. By that, therefore, the price of what? Of that market value of that share will now what? Will now drop. That is why you see the market value of what? Of securities at the end of the year very high. But in the following year, the market price will just what? It will drop because what? They have paid out all their what? Obligations that make out what? All their payment, all they need to pay. At the end of the year, they have paid it out. So you see the market price what? Coming down. So in order not to overcast the market value of what? Of such shares, you need to do what? You need to remove the dividend from such market value if the year that what? The dividend is about to be paid. As simple as that. Also, the year what? Dividend is due for payment. It means this dividend is due but you have not paid. Definitely, if you now look at the market, if you now look at the value of the company, if they now pay what dividend, what will happen? It means they have paid out of their money, out of their resources. It means the resources will also drop. So, but if they are taking that market value when they have not paid the dividend, it means you are overshooting, overcasting, you are increasing what? Treating what the market value of the company. So you need to remove the element of dividend from it in order to determine the true nature, the true value of the shares of that company. That is why you need to do what? To use market value exclusive for dividend. If you now hear what dividend has been paid, it means that what the market value given to you is what? Exclusive of dividend. You don't need to do what? To adjust for anything. So by implication, these two, it means what? The market value is inclusive, is what? Inclusive of dividend. Inclusive. Market value inclusive of dividend. Market value. Market value is inclusive of dividend. But in this case, dividend has been paid. It means it has been paid. So the market value they are saying there is what? Is the true value of what? Of that shares. So there's no need to do what? To adjust in such case. But where the examiner is silent, that is, it does not give you a clue whether the dividend has been paid or the dividend has not been paid. It means the examiner is silent. In such case, you assume market value given to you is what to SD. In this case, too, so you assume it's what to market value SD. Having said this, I hope you understand when to apply each of these formula. When to apply this, when to apply this, and when to apply this formula. So you apply this formula when there is no growth in dividend. You apply this formula when there is growth in dividend, and you are giving dividend in year 0. You apply this formula when there is growth in dividend, but you are giving dividend in year 1. So they need to do what? To put 1 for there again. So at this stage, we are trying to do what? To explain to us how to calculate the cost of equity. Now, in our subsequent video, we shall be looking at how do we calculate growth rate if we are not given. Because the examiner may tend to give you growth rate, and it may tend also not to do what? The other way around, may not give you the growth rate. And you want to calculate your cost of equity. How do you calculate the growth rate? In our next video, we shall be looking at the concept of what? Of growth. How do we calculate growth? In order for us to do what? To solve any question we have. At this junction, we call it a class today. And in our subsequent video, we shall be looking at the concept of what? Of growth. Thank you and God bless.